Hello, everyone. Thanks for being here today for this webinar presented by the research center known as Behavioral Economics in Action at Rotman, or BEAR, where I serve as a research fellow alongside many dedicated colleagues. I'd like us to start by acknowledging that the land on which the University of Toronto operates is the traditional land of the Huron-Wendat, the Seneca, and the Mississaugas of the Credit. Today, this meeting place is still the home to many Indigenous peoples from across Turtle Island, and we're grateful to have the opportunity to work on this land. Even though we are meeting virtually, it's essential that we acknowledge and give thanks to the local Indigenous peoples and communities for sharing this land. Furthermore, I believe it's incumbent upon each of us to take an active role in learning the true history of our collective past and to engage in meaningful actions towards creating a more equitable and just future for Indigenous peoples in Canada. A land acknowledgement is just a tiny first step towards those goals, and I hope you all personally pledge to do much more. My name is Lisa Kramer, and I am the Verican Chair in Behavioral Finance and a Professor of Finance at the University of Toronto. I have the distinct pleasure of moderating today's seminar. We're delighted to have today with us Meera Paleja from the Ontario Securities Commission. Before I introduce her, I'd like to go over the ground rules for this webinar. Throughout the session, please submit your questions by clicking the Q&A tab at the top or bottom of your Teams screen and typing it into the entry box. At the end of the talk, and with time permitting, we will have a question and answer session where I will select questions from the Q&A tab. Without further ado, I'd like to introduce Meera. Meera Paleja is Head of Investor Research and Behavioral Insights at the Ontario Securities Commission. She leads a team applying behavioral science to understand retail investor decision-making with recent work on social media finfluencers, artificial intelligence, and digital engagement. Meera brings experience from federal and provincial governments, the private sector, and academia, including teaching at Rotman. With a PhD and postdoc in cognitive neuroscience, she bridges research and policy to drive meaningful change in financial regulation. In her spare time, she enjoys travel and photography, which she showcases on her personal website. Judging by the images, Meera, if this behavioral insights gig doesn't work out for you, you have a great future in store as a travel consultant and globetrotting photographer. Thank you, Meera, for being here today. Please take it away.
Thank you, Lisa. So today I'm going to be talking about using behavioral science to enhance the investor experience. And before I dive in, just a quick disclaimer, the views being expressed are my own and do not necessarily represent the views of the Ontario Securities Commission. So let's start with a story about a particular aircraft. So it was 1935. Boeing unveiled what was then the most advanced airplane ever built, the B-17 Flying Fortress. It was faster, more powerful, and more complex than any other plane before it. During the first test flight, the top pilot in the U.S. Army Corps took off, and a few minutes later, the plane stalled, rolled, and crashed. Investigators found that there wasn't actually anything wrong with the aircraft. So the pilot had simply forgotten to release a small locking mechanism before takeoff. The official report called the plane too much airplane for one man to fly. Boeing nearly lost the Army contract and would have gone bankrupt. The Air Corps wanted to go with a smaller and simpler plane instead. But the B-17 crash wasn't caused by bad engineering. It was caused by assuming perfect human behavior. So instead of redesigning the plane, they redesigned the process. They introduced something that was actually quite revolutionary at the time, a simple written checklist. And from then on, pilots didn't rely on memory alone. The B-17 went on to become one of the most important aircraft ever built because the new process put human behavior at the forefront. And that's really the heart of behavioral science. And also the limitations of our securities laws. Our regulatory systems were designed like that first B-17, brilliant, complex, technically correct, but they assume flawless human pilots. In reality, people forget, don't pay attention, get overconfident, tired, and all of these impact the success of the system. So what we need is behaviorally informed design, systems that account for how humans actually act, not how we wish they would. So let's talk a little about the assumptions behind our securities laws. There's a theory called the efficient market hypothesis, and this is a theory that dominated the field of financial economics. And what it says is that the prices of financial assets always reflect all the available information. And so a theoretical assumption is that investors are mostly rational in how they will react to the information provided. We now know there are very real limitations to this theory, but indeed, Canada's most important securities laws were written and adopted between the 1960s to the 1980s. And this was the golden age of the efficient market hypothesis. In an efficient market, if regulators want to ensure that capital is allocated efficiently, they have to ensure that there's timely and correct disclosure and that dissemination of information related to the underlying assets are provided to these rational investors. There's a belief that the public will read, understand, remember, and act rationally on the basis of this kind of mandated disclosure. The problem is this belief goes against decades of evidence from psychology and the behavioral sciences that shows that people are actually very selective in attention, comprehension, memory, and behavior. So our disclosure regime and information-based practices, while they're useful and necessary, are ultimately incomplete in ensuring investors are behaving in a way to optimize their experience. In other words, our securities laws are like the B-17 plane before there was a checklist. So Herbert Simon said, "A wealth of information creates a poverty of attention." So this was the Nobel Prize winning economist, Herbert Simon, and his view is that we are boundedly rational, meaning rationality is limited when individuals make decisions. We don't have the mental resources to do a cost-benefit analysis for every decision. Under most conditions, we select a decision that is satisfactory rather than optimal. And so many of you have probably seen this kind of framing before. And so the traditional economic model of human behavior stipulates that human beings are perfectly rational decision makers. They possess unlimited attention and memory. They have access to complete information. They make cold and calculated decisions, and they seek to maximize decision utility. Conversely, behavioral science stipulates that human beings are not perfectly rational decision makers. They possess limited attention and memory. They have incomplete access to information. They're influenced by intuition, emotions, and biases. And what the past 3 decades have shown us is that even something as unrelated to your investing outcomes, such as weather, influences investing choices. So investors become more bearish when days are short and dreary. It's known as the September effect. We also note that people don't necessarily maximize their decision utility. So when you think about it, financial information is complex. It contains lots of information. It involves trade-offs between the present and the future, and it triggers emotions. And so even though humans are what we call boundedly rational, we can predict with some confidence how their behavior and decision-making will be impacted depending on what information they've been provided or how their options are framed. The famous academic duo in psychology, Kahneman and Tversky, came up with prospect theory to explain the experimental finding that people react differently in the face of potential gains versus losses. We know that people react much more strongly to losses than gains, and that they're more likely to take risks to avoid losses than they are to have more gains. There's also the phenomenon of anchoring. So we're anchored to information that's presented early. A well-known study looked at how people estimated the percentage of African countries in the UN, and if they were higher or lower than a random number from a Wheel of Fortune. Those who saw a higher number on the wheel estimated a higher proportion of countries, whereas those who saw a lower number had the opposite result, even though the participants knew the generated number was random. There's also the phenomenon of endowment. We view things that we currently possess as higher in value than things we don't. And there's present bias. We prioritize the here and now over the future. So when I was a adjunct professor at Rotman, which I was for 6 years, there was an activity I did every semester with the class where I asked people if they would prefer $5 today or $7 2 weeks from today. So when you frame the question like that, which is how it was administered to one half of the room, most people said I would take the $5 today. In the second half of the room, they got a slightly different variation of that question. So they were asked, would you prefer $5 1 year from now or $7 1 year and 2 weeks from now? So in both cases, the $5 and the $7 would be given 2 weeks apart. But in the second case, the decision is removed to 1 year in the future. When it was framed as 1 year in the future, the majority of people actually chose the $7 instead of the $5. And why is that? Because temptations are only tempting in the present. So now that I have removed that decision to 1 year from now, you choose the quote, higher reward, the smarter option, which is the $7. And this was a very consistent effect across the different classes that I taught. Regardless of the fact that we were learning behavioral economics, most people chose the $5 if they could get it today and chose the $7 if it was removed 1 year from that day. So next, I'd like to tell you a little bit about the story of GameStop. So how did some of these principles we talked about apply to a real world example of something that happened in the capital markets? So in early 2021, GameStop was a video game retailer on the brink of bankruptcy, and it was one of the most shorted stocks in the market. However, thousands of retail investors on the Wall Street Bets forum on Reddit, in a concerted way, drove up the stock price of this struggling video game retailer to really unprecedented levels, creating a short squeeze. And what was astounding about this is that the stock price reached well beyond the fundamentals or valuation of the company. So when I look at these events, what I see are the psychological and behavioral underpinnings of what occurred. Herd behavior is something we saw here, and it's something we're wired for. In ancestral times, this helped with our survival. In today's age, threats to our survival are generally less prominent, but the behavioral tendencies we're wired for continue to exist. So when it comes to the ease with which social media can propel herd behaviors, we're presented with new challenges when it comes to investor protection. When we tried to understand what happened with GameStop, we saw the use of digital engagement practices and gamification in a popular trading app, which helped drive much of what we observed. So a little bit more on this later. And what we saw is that as the stock started climbing, there was really this recency effect, the tendency to overweight recent events like a dramatic surge without considering the overall market trends. And indeed, the stock price in this episode eventually plummeted, with many investors losing quite astounding sums of money. So the consideration of the science of human behavior, not just how we want or expect people to act, will be central in helping to minimize the impacts of adverse outcomes in the future. So I want to dive deeper into the insights that behavioral science offers that can make an impact on securities regulation specifically. So how are we applying behavioral science at the OSC? So these arrows are shown as unidirectional, but they really could be bidirectional. So we're gleaning information from our existing laws, from academic and other literature to inform our research areas, and also the design and interpretation of our findings. Our insights are also leveraged for policy and regulation, as well as investor education efforts inside the OSC as well as beyond. So we are generating new evidence that is used for initiatives around the OSC and with other regulators and authorities as well. But we're also taking in that information to help us develop new ideas for what to test and what to look at next. So we've recently published numerous reports on our behavioral science research, so spanning the domains of artificial intelligence, dark patterns, gamification, and social media. The following research that I'm about to discuss is run similarly. So we have research participants who are also retail investors that are being exposed to different experimental conditions where they use a simulated trading platform, and they're asked to make hypothetical trading decisions online. So I'll focus on the findings of each experiment for the purposes of today. We published 2 research reports on gamification and retail investing. So the first one was in 2022 and a second published last fall. Both of these pieces of research examine the effects of different gamification techniques used by mobile investment platforms on investor behavior. So this research came about on the heels of the GameStop events in 2021, and we wanted to understand what features could be driving investors to make these decisions. Our 2022 research showed that rewarding participants with points for completing trades resulted in an almost 40% increase in trading frequency. So note that these points had negligible or no economic value. So they were just points administered when people completed a trade. And nevertheless, we saw that it substantially increased the degree to which they traded. So we know increased trading frequency is associated with lower investment returns in the long run. We also found that prioritizing stocks on a top traded list led to a 14% increase in trading of those stocks. Investors engaging in herding behavior with their investments can also erode returns. Our recently published research, so the work published last fall, builds on this idea of promoting stocks by using gamification techniques. Our second experiment found that stocks promoted to participants through a social feed led to a 12% increase in the trading of those stocks, while stocks promoted by a copy trader led to an 18% increase. So once again, a focus on trading specific assets presents risks to investors. This could be in the form of excessive risk-taking or perhaps a lack of proper diversification. So taken together, our research reports highlight the fact that gamification techniques can be used on digital investing platforms in ways that lead investors to engage in problematic behaviors, such as increased trading frequency and also herding towards specific stocks. So we also published some work this past April on social media and specifically finfluencers. So a finfluencer is an online personality who offers advice, tips, and guidance on how to manage money, invest wisely, achieve financial goals. Many of these individuals are unregistered, they lack credibility or credentials, and they might present an investor protection concern. Our broader research project consisted of 2 parts. So first, there was survey research to understand investors' perceptions and experiences with social media influencers, and also an experiment to understand how investors respond to influencer recommendations. Our research showed that of those who have made a decision based on influencer advice, they are 12 times more likely to have been scammed on social media. And this is a finding that converges with other research in this space. They're also twice as likely to have reported significant investment losses in the past, and they're 3 times less likely to have worked with a financial advisor or portfolio manager. We also ran an experiment using a simulated social media feed and trading platform to understand whether social media posts have the ability to increase uptake of a promoted asset. We found that indeed investors were 4 times as likely to purchase a promoted asset if advertised on social media than not. We also wanted to understand to what extent influencer messaging could be mitigated in the case where we feel there are investor protection concerns. And we saw a few interesting things. So the first is that providing clear disclosures helps mitigate the impact of influencer information. We also saw that pre-bunking, providing general information about scams, could help counteract the impact of the scam. The technique that we found was the most effective was inoculation. So this is where you present a weakened version of a scam one might encounter, and therefore people who have been inoculated when they encounter the stronger version of that message. So that was the effect that had the strongest impact in mitigating the impact of influencer messaging. So last fall, we published 2 reports on artificial intelligence and retail investing. Our first piece of research asked, how is the average retail investor feeling about AI as a source of advice? And what we wanted to know is whether they are more likely to adhere to investment suggestions from AI, a human being, or an AI-human blended model. So we tested investment advice coming from one of 3 sources. So one was the human, one was an AI, and the third was that blended human AI model. And what we saw is that there was a slight difference in people's adherence to advice that came from the blended model. But importantly, this was not statistically significant. What was perhaps more interesting was the fact that we didn't see a significant difference between human and AI advice. So we saw that people responded to that roughly quite similarly. And I'll note that this research took place in 2023, so quite a while ago when you consider how far AI has come. But even at that time, we saw that there might be a level of trust that retail investors have from getting advice and recommendations from AI. Our second report examined AI in scams with an emphasis on the efficacy of exams and also potential strategies to help mitigate them. So what we wanted to look at was, does AI have the potential to turbocharge conventional scams? And how could we mitigate the impact? We saw that AI scams do indeed have the potential to increase the reach, efficiency, and effectiveness of conventional scams. And we also saw that techniques to mitigate the impact were the ones that were timely and specific. So what we tested more specifically was a web browser plugin. And this alerted you when you encounter a potential scam. So this had the biggest impact at mitigating the effectiveness of AI-generated scams. And so in sum, behavioral science, what it really does is it presents a complementary approach to traditional regulatory tools to enhance the investor experience. Our goal is not necessarily to replace the conventional regulatory tools, rather it's to enhance them by using behavioral science to generate evidence. And a lot of the times the way behavioral science works in our context is that it can act as a clue. So what gamification techniques are actually harmful based on our evidence? What should we take a closer look at? And so sometimes in a very complex regulatory space, in an environment where there's a lot of complexity, a lot of things going on, a lot of things changing very fast, behavioral science can help us hone in on the areas that we might want to investigate further as a regulator. We also see that investors use a lot of irrelevant information to make fairly important decisions. And what behavioral science does is it can help us identify solutions that really can enhance the experience for investors. So how can we get retail investors to ignore superfluous information that won't have an impact on their well-being or on their outcomes, and get them to really focus on the things that actually matter? And so what the kind of collective research at the OSC shows is that we can really leverage behavioral science to take the human perspective into account, right? It is in our analogy of the B-17, behavioral science is the checklist, and the security laws are plain. And what it allows us to do is really gather human-centric evidence in rapidly evolving and topical areas. So if we want to look at fast-moving areas such as AI, digital engagement practices, social media, help us understand what we should be concerned about and what maybe is not something we need to apply or immediate attention to, for the sake of focusing on the things that might actually matter and might present concerns in the immediate. Behavioral science is a really good way for us to generate that evidence. So with that, thank you very much. If you would like to check out these reports in more detail, this is a link that is of no use to you, actually, because I know you can't click this PowerPoint. But if you Google OSC Investor Research and Reports, you should have access to all the reports that we have available. They're in HTML format. If you prefer the PDF, you can even print those off. And of course, if you have any trouble accessing anything, please feel free to reach out to me directly, and always happy to discuss. And happy to take any questions.
Thanks so much, Meera. I really appreciated hearing about the research that you and your colleagues are doing on gamification, social media influencers, and artificial intelligence in the retail investor space. So that was hugely informative. Thank you very much. I thought I would start with a question that popped into my head around the work you've done on social media influencers. So you mentioned clear disclosure, pre-bunking, and inoculation were helpful in the lab. When you think about balancing the need to sort of protect investors versus allowing, let's say, freedom of expression online, from a regulatory perspective, can you think about ways to apply those learnings in a policy context?
Yeah, so there is this is a space that is being examined by regulators across Canada, the Canadian Securities Administrators, so this is something that is very top of mind in terms of what how the policy is being looked at. So one of the things that I'll say is that to provide investment advice online, you need to be registered, and so that's a kind of important consideration. So anytime you're providing that advice, that's something that people should have under their belts. There's a little bit of a gray area when you think about people who are talking about what they've done and how they've found success. And so these are areas that are important to consider from a policy perspective. And so it's we found that overall there are some influencers who are adequately credentialed that are offering information that does not seem as harmful as what other influencers are providing. So there's certainly a range of information out there. And I think from a policy perspective, the OSC and other regulators are taking a close look. Lisa, you're on mute.
Thanks, Meera. I think we've probably all had the experience where we have a member of our family send us a link to TikTok containing some groundbreaking financial research that they hope will incorporate into our own lives. It's a bit terrifying when those people who aren't actually appropriately accredited expound on social media. So I think we're all grateful for what the regulators are doing on that front. Um, I wonder as well on the finfluencer front, have you thought, you or your colleagues, about the idea that different generations are maybe tapping into social media at different levels of intensity and what that might imply for the impact that might have on people's personal finances?
Yeah, so there was some work done by the CSA Investor Index. So the last report came out 2024, and they looked at the patterns of where different age groups are seeking out information about finances. And what they are seeing is that older adults, so I believe it was over the age of 60, are disproportionately more likely to seek out a financial advisor, portfolio manager for their information, and younger adults are disproportionately more likely to use social media as a source of that information. There's some work showing that following those social media advice might result in lower returns. I say that with a little bit of caution because the study that I'm thinking of was looking at if somebody followed 100% of the advice they were given from a certain type of influencer, how that would theoretically impact. So we don't know, what would happen in kind of your typical case where you're exposed to some influencer content, you're using some non-influencer content, and you're being deliberative and you're making decisions about the things that influencers point you to. So it's very unlikely that most of the time it's a one-to-one relationship. People get influencer advice, they do immediately what the influencer recommends or suggests. People are looking at multiple sources of information, they're doing further research. But there's some evidence to suggest that seeking out information from a variety of resources might be more beneficial. However, as far as I know, there haven't been studies looking specifically at like younger adults, older adults, and how they're performing based on the source of information that they use.
Maybe a future study. Some great questions in the Q&A as well. There's one from Tanjin. How long were the experiments, I think, in duration that you ran? And do you think people to some extent can learn from their mistakes? For example, over investing under gamification, can they learn over time and then mitigate those effects?
Yeah, so I think in terms of the timing, I want to say about 20 minutes for the experiment. Don't quote me on that. I'm sure the information is somewhere in the report and in the methodology. But generally speaking, they were kind of shorter interventions. So we're capturing kind of multiple decisions made within a certain window. And then the second part of the question about people kind of, and sorry, it was Lisa, they were asking if people could show improved behavior over time.
Yes, exactly.
Yeah, so I mean, I think that's the goal. I think that with some of the ways mobile investment platforms are designed, they're designed to capture your attention, to keep you on there a lot, keep you engaged. And so what it ends up being is just another one of those apps that you spend a lot of time on. And a lot of the times you're best strategy, not always, but a lot of the time is a little bit more buy and hold. So you want to not think about your investments constantly. You want to kind of just leave things there and let things grow without intervening. But the problem is that's the way that they're designed. I think that it's an interesting research question around what happens over time and how do people fluctuate in their use of those mobile apps, and do they develop some resilience? For example, if they experience loss, do they then go and change their patterns? But I think those are all good research questions.
Great, thank you. Turning to a question from Macy on AI. She wonders if you know of research on why investors trust AI as much as human advisors, and perhaps is it because we lack understanding on how AI works behind the scenes, or maybe other reasons, if you're aware?
Yes, that's a really good question. So our research in itself didn't really explore the why. But I would surmise that one of the reasons that people trust AI is because they feel as though it is a less biased source of information than human beings, that it has access to a huge swath of data from which it draws its conclusions. And that's not necessarily the case for human beings. Notice certain information more. They're prone to kind of recency effect and all the other kind of biases that we've already talked about, and that informs what information or advice they might give. So I think that I don't think we necessarily have enough data yet on whether AI is actually a better source of investment advice than human beings. But nevertheless, the perception might be that it's just less biased.
Jumping around a little in the Q&A, I'll go to a question that was upvoted regarding brokerages like robo-advisors, for example, that seem to be leading the pack in gamification. And so whether you're able to comment on what the OSC perhaps is doing to support Canadians in this context. The question points to the hyperdilution and blurred lines between regulatory responsibility to clients, for example, commingling of investing advice and the self-directed platform capabilities with sort of hard to find disclosures. Often the fine print is really tiny.
Yeah, so I would add there was very recently a sweep that was conducted by the OSC, specifically looking at digital engagement practices in mobile investing platforms. So they leveraged a lot of the insights that we found through our reports. This is something that regulators internationally are looking at more broadly. But what they found is just that different firms are using gamification techniques in different ways. And also that there were cases where there were what we would refer to as deficiencies, where there were some issues where this could potentially mean that they might not be in compliance with securities laws. And so when that was the case, as part of the review of these different firms, what we do is we issue a deficiency report, and then within 30 days, all of those issues were corrected. So the issues that were in our sweep. But that sweep is publicly posted. So if you take a look, you can Google OSC Digital Engagement Practices Sweep. And you should be able to find more information on that. So it really is an example of how some of this research on digital engagement practices is being used to inform policy and to inform your more standard regulatory processes inside the OSC. But it is something that's top of mind. We're trying to stay on top of all of the research in how we carry out these sweeps, and actually looking at the specific firms that could be doing things that we're concerned about.
Great. There's a kind of a big picture question from Helen. asking what is an easy win to help investors focus on investing in the right way when we understand they aren't using perfect information and are focusing on superfluous information. So I think this is like taking a step back from your specific studies and thinking more generally about the kinds of biases that investors are susceptible to and how generally we might try to address those.
Yeah, I mean, I think this is kind of the $1 million question, right? I think that the way I see it is that um, we're using behavioral science to identify some of the specific techniques that might be problematic when it comes to retail investors. I think that that work needs to be complemented by investor education and outreach activities, because we can nudge somebody into doing something that, for example, means they have a more diversified portfolio or something that is seen as beneficial. But if they don't understand the why, is it something that will translate the next time they use a different kind of platform, or when they have a different kind of exposure to influencer information. So I think that that education piece really helps develop a kind of foundation. And then what the approach of behavioral science can do is really enhance those efforts. And then, of course, we need regulation, right? So we need kind of the cases where there is a level of enforcement to ensure that investors are being protected. So I think that all of those pieces need to work in harmony.
Great. I might just take moderator privilege in asking the last question, which is just from your perspective, working as a behavioral scientist in a regulatory organization, what are the biggest barriers to doing behavioral science research at a securities regulator? And relatedly, how has behavioral insights been received overall at the OSC? Is there, generally speaking, support for the work?
There is a huge amount of support for the work. And I think that the OSC is unique in that sense. I've done behavioral science in a lot of different roles in my career, applied behavioral science. And the OSC is really embracing the approach, the findings. We're seeing the impact of our work, how it's being implemented in securities regulation. So I think that there is very much an embrace of like the kind of work that we're doing. And so I think that when it comes to like the securities regulation space and the behavioral science space, this is a great place to be, putting a plug out there in case we're ever hiring students or young researchers, that this is definitely a great place to be to do applied behavioral science. The other thing that I'll say is that in your question about are there other kind of barriers or things like that impact what we're able to do, what we're not able to do. I think that one of the things that I've always been looking to do, which involves, I think, a bit more of the stars aligning, is doing a little bit more field research. So actually looking at what are the impacts of certain interventions in the real world and real world behavior. So far, it's been online experiments, which are great. You can be very precise with what you want to test. It's relatively more controlled. But looking at our behavior in the real world is definitely, I think, the next frontier for behavioral science at the OSC. And so that's something we'll continue to explore, and whether it's something that we could feasibly do in the near future.
That sounds extremely exciting and interesting. And I think we're going to have you back to bear to tell us about the results of field research and field studies when you ultimately get to them. So excited to hear that. So thank you very much, Meera, for being here today to share this really insightful work with us. Everybody, a full recording of this webinar will be available at our website, I think within a few days or a week, by clicking the tab called webinars on the website. You can, when you're ready to go, exit this webinar by clicking leave at the top of your screen. Thank you again very much, Meera, and thank you everybody for attending our webinar. Our next webinar will be February 10th, 2026, and information will be updated on our social media platforms. Thank you again, everybody. Have a great day.
Thank you, everyone. Bye.